Welcome back, everyone. If you've been investing for a little while, say a decade or so, you probably know that something magical happens with your portfolio every 7 years, or about that range of time. And if you just started your investing journey, then boy, are you going to love this. So, every 7 years, the money that you invest should double. That's right, it should double in value. Every $100 turns into 200, 1,000 into 2,000, 50,000 into 100,000, and on and on and on. This doubling effect will also continue as time goes on. So in 14 years, your money should double twice, which would mean that you would now have 4 times as much money as you originally started with. 100 turns into 200, and then 200 turns into 400, 2 doubles, or a 4x multiple. In 21 years, your money should double 3 times, or turn into 8 times the value that you originally started with. In 28 years, it should be a 16x multiple, and a 32x multiple in 35 years. If you double your money enough times, it can turn into real wealth. Sometimes this doubling effect will happen faster than 7 years, and sometimes it'll take a little longer, because the stock market swings up and down depending on what is going on in the world. Maybe there's a recession or a financial crisis, and you have to wait a little longer to see your money double. But there's also periods of economic booms where your money will double much faster than average. And of course, whether or not you actually get to experience this doubling effect depends on whether you invest in the right stocks or funds. And believe it or not, you don't have to invest in the next hottest thing like Nvidia or Tesla to double your money every 7 years. The 7-year doubling effect can be achieved with average market returns. Matter of fact, you should consider it as a baseline for evaluating your investment performance. So if you've been invested for more than a decade and your money hasn't doubled, perhaps it's time to reevaluate your strategy. Because the last decade was an exceptionally good time in the market, and your money should have more than doubled. And now a quick word from our sponsor, Quality at a Fair Price, a free weekly newsletter I recently launched, where I share with you what I believe to be high-quality stocks trading for attractive prices. If that sounds like something you may be interested in, you can check out the latest edition about ADP. There's a link in the description below. There's a really neat trick to help you figure out how long it'll take for your money to double. It's called the Rule of 72. All you need to do is divide 72 by your annual rate of return, and the result is the number of years it'll take for your money to double. Obviously, we don't know what type of returns any investment will generate in the future, but we do know how fast certain stocks and funds have grown historically. We can take these historical returns and use them as a rough guide of what we can expect to happen in the future. Of course, it's better to be conservative when making your assumptions, but let's take a look at a few examples to see what they can tell us. I'll start with SPY, the Spider S&P 500 Trust ETF that tracks the S&P 500 index. Since 1993, this fund has a compounded annual growth rate of 9.89%. If we go ahead and divide 72 by 9.89, we come up with 7.28. So it took roughly 7.25 years for an investment into SPY to double between 1993 and today. As I mentioned earlier, this doubling effect isn't very precise, and with SPY it didn't consistently happen every 7.25 years. Let's look at the actual returns for this fund to see how long it actually took for your investment to double. I'll start with a $10,000 investment on February 1st, 1993. By April 30th of 1997, the value of this investment crossed $20,000. So it took 3 years and 3 months for the first doubling effect to happen, much faster than the average 7.25 years. The next doubling, so going from 20,000 to 40,000, almost happened by August of 2000. There may have been some intra-month day here where the fund did actually cross the $40,000 threshold, but my chart only shows month-end values, and while we were close, it didn't actually cross 40,000. Then of course came the dot-com bubble, and the stock market tumbled. So investors had to wait until November 30th, 2006 for their SPY investment to actually cross the $40,000 threshold. That means the second doubling effect took 9 years and 11 months to happen, so a little longer than the average 7.25 years. But if we combine both doubling periods, it took SPY a little more than 13 years to double twice, still leaving it on pace right around the 7-year mark for each doubling period. The third doubling effect took a little longer as well, because as you all know, the financial crisis happened shortly after 2006, and SPY, along with the rest of the stock market, tumbled. The original $10,000 investment crossed a valuation of $80,000 by January 31st of 2017, which means that the third doubling effect took 10 years and 2 months to happen. Again, a little longer than average. But the fourth doubling effect only took 4 years and 7 months, and this occurred on August 30th of 2021, with the value of our SPY investment crossing $160,000. Since then, about 2 years have passed by, but the value of that original investment in SPY is about $183,000 today, so still pretty far away from the fifth doubling effect that would see the valuation cross $320,000. When viewed over a very long time frame, the doubling effect sounds very appealing. However, the monthly and even yearly fluctuations in the market can be challenging to swallow. What you have to do is remind yourself that the stock market swings through both good and bad periods. Even though it may seem like the bad periods last a very long time, they always come to an end and are followed by a great period. If you look at a long enough period in the market, the good periods always outweigh the bad periods, and this means the stock market always goes up in the long run. Let's look at something that has grown faster, like Apple for example. Since 1985, Apple has a compounded annual growth rate of 22.41%. If we go ahead and divide 72 by 22.41, we come up with 3.21. So invested in Apple, our money would have doubled roughly every 3.25 years. That is stupid fast. Just to put this into a dollar context, at this rate of return, $10,000 would turn into almost $25 million since 1985. Granted, that is a very long period of time, but the doubling effect here is out of this world good. And lastly, let's take a look at my favorite dividend ETF, SCHD, Schwab's US Dividend Equity ETF. Since November of 2011, this fund has a compounded annual growth rate of 12.37%. If we go ahead and divide 72 by 12.37, we come up with 5.82. So an investment into SCHD would have doubled in value every 5 years and 10 months. Today we are about 12 years since the inception of SCHD, and by the quick math we just did, the value of this fund should have doubled twice in this span of time, and it has. A $10,000 investment into SCHD at its inception would have a value of about $40,000 today. For any SCHD investors listening to this, or potential investors that are looking at SCHD, you may be wondering what type of returns this fund can generate in the future, or whether the doubling effect every 6 years will continue to hold true. The simple answer is, I don't know any better than you what the future has in store for SCHD. But if I were to make an educated guess, I would assume that SCHD will not be able to maintain its 12% compounded annual growth rate it has enjoyed since inception. The fund was launched at a pretty opportune time in the market. We know that now in hindsight. But it's not like Schwab foresaw that the market was going to be strong and decided to launch SCHD at the exact time they did. Things just worked out that way. I would assume that SCHD can deliver average market returns over the long term, which would place it somewhere between an 8 and 10% compounded annual growth rate in the next few decades, which would be a very good place to be. The fund would still double investors' money every 7 to 9 years. Sometimes faster and sometimes a little slower, but I do see value in this fund above many other dividend investment vehicles. SCHD is a low-cost fund with a pretty attractive dividend yield and strong dividend growth potential. I think the strategy it is based on makes fundamental sense, and it will continue to provide pretty good returns over long periods of time. Sure, we will see bad years, but we will also see exceptional years. You know how they say you should buy low and sell high? This is easier said than done. 2023 is a perfect example of this. SCHD has struggled this year, barely climbing to a positive year-to-date return here towards the end of the year. Meanwhile, the S&P 500 is up almost 25%. It's not easy to hold shares of SCHD and watch your portfolio get left in the dust by the broad market, not to mention if you are still contributing to your position. But you have to ask yourself, are you investing for tomorrow or for 10 years from now? If it's for tomorrow, then frankly you have no business gambling in the stock market. But if your goals lie years or decades in the future, then ask yourself, what's so bad about a flat or falling share price? If you like SCHD, then you should be happy you can continue to buy it for the same or even lower price all year. If you liked it at $70, you should like it even more when it drops to $65. Your dividend reinvestment and the dividend snowball also pack a bigger punch during these flat price periods. as they purchase more shares of SCHD for you. Sooner or later, SCHD will deliver better returns, and we will likely look back on 2023 as a pretty good time to buy into the fund. It's easy to play Monday morning quarterback. You can tell yourself you should have sold SCHD for Nvidia at the start of the year. Today you could switch back and have twice as much SCHD. That would have been a smart move to make. Granted, it's pretty easy to say that today, when we can look back at how the year unfolded. What already happened is in the past, and it does nobody any good to dwell on missed opportunities. You should focus on the future instead. If you think the next 12 months are going to see strong market returns, then perhaps it makes sense to reposition yourself away from SCHD into a stock or fund with more growth potential. But this also begs the question, if your focus is on generating bigger returns than SCHD can offer, then maybe SCHD isn't the right fund for you. Roughly 15% of my invested assets are allocated to SCHD, and my holding period is forever. I added quite a lot of money into this fund in 2023, and I will do so again in 2024. I do so because I like this fund for the reasons I stated earlier. It's a low-cost fund that pays an attractive dividend and has the potential for above-average dividend growth. I also think the underlying strategy SCHD is based on is strong and that it can deliver good returns for many more years to come. If you enjoyed this video, please do me a favor, give it a like and subscribe to the channel. Thank you for watching and see you next time.